Thank you for joining us for today's webcast, the Section 1411 Net Investment Income Tax. I'm Jeff Rogers, and I am a tax partner at Feeley Driscoll, PC, a regional accounting firm based in Boston, Massachusetts, that services companies and individuals across New England. I'm joined today by Bill Moore, who is a manager in our tax group. As I mentioned, we will be discussing the net investment income tax, which was originally introduced as part of the Patient Protection and Affordable Care Act of 2010. It went into effect this year, 2013. There was an additional tax that introduced as part of the Health Care Act, the additional 0.9% Medicare tax. We covered this in a previous webcast, so we're not going to get into much detail here. However, just to clarify, this additional Medicare tax was merely a tax rate increase that applied to certain employees and self-employed individuals. The net investment income tax is an entirely new tax that is being imposed. It has required its own section of the Internal Revenue Code, Section 1411. And in fact, final regulations were recently released. If you were planning to rely on the proposed regulations, which were released about a year ago at this time, we would strongly recommend that you go back and take a look at the final regs because there were items that changed. And on that note, I'll turn it over to Bill, who will provide an overview and some of the nuances of this new tax.
Thanks, Jeff. So this tax is a 3.8% tax on what is called passive income. We'll get into what is passive income in an upcoming slide, but to start, it is a new tax imposed under Section 1411. It's a 3.8% surtax on net investment income of individuals, estates, and trusts. This doesn't apply to anyone. You must be an individual, and it applies to the lesser of your net investment income or the excess of modified adjusted gross income over $200,000 for single taxpayers and $250,000 for married filing jointly. Modified adjusted gross income can be defined as adjusted gross income, which is on the bottom of the first page of your tax return. There are a few exceptions, but we'll keep it at that for this presentation. For estates and trusts, this applies to the lesser of undistributed net investment income or the excess of estate or trust AGI over the dollar amount at which the highest tax bracket begins, which for 2013 is $11,950. So there's not a large amount of income that can go through a trust and not be subject to the tax. We're going to go through a couple examples of how this works and then go through the categories of income that it applies to. X and Y are married and have income of $500,000 in total, all of which is salary. None of the $500,000 will be subject to the 3.8% surtax. However, $250,000 will be subject to the additional 0.9% Medicare withholding tax. Again, that 0.9% kicks in wages over $250,000. So in that example, there's no investment income, but there is $250,000 of wages over the threshold. Second example, X and Y are married, filing jointly, and have salary of $500,000 and $50,000 of net investment income. The surcharge would apply to the entire $50,000 of the net investment income. Again, starting at the amount over $250,000 or net investment income. The lesser of those two in this case is the $50,000 of net investment income. Third example, X and Y are married, filing jointly, and have $225,000 of salary and $125,000 of net investment income. The surtax would apply to $100,000, which is the amount over the $250,000 modified adjusted gross income threshold. But then you would think it would be $125,000, but because the salary is only $225,000, it kicks off at $250,000 or the net investment income. So that first $25,000 would not be subject to the surtax. In the last example, X is a single filer with $600,000 of interest and $500,000 of net capital loss. The surtax would apply to the $397,000. This would be the $600,000 minus the $200,000 threshold, because he's a single filer, minus the $3,000 maximum capital loss available to offset ordinary income. So that $3,000 has nothing to do with this act. That's just the general rule that if you have capital losses in excess of $3,000, they can only be offset against capital gains. If you have no capital gains, you do get the $3,000 regardless. Now just to clarify the example of the trust. Again, the surtax with the trust begins at the highest tax bracket, which is $11,950. So if the trust has $150,000 of net investment income and the beneficiary has no other income, if there's no distributions made, $138,150 would be subject to the net investment tax. So that's an additional $5,200. If the income is distributed to the beneficiary, because in the example there's no other income, no one would be subject to the tax, as the $150,000 is beneath the $200,000 threshold for the single filer. There may be non-tax reasons not to do this, but from a tax standpoint, it's very beneficial to pass that through. Now we talked about the tax and went through a few examples. Now we're going to discuss the three categories of investment income that this applies to. The first category is interest, dividends, annuities, royalties, and rents. Rents we'll go through in a moment, but for the general sense, these are just rents for a single person that has a second property that's rented out. We call this passive income. Passive income will be defined in more detail later. The second category is income from a trade or business that is passive to the taxpayer under Code Section 469. Now, when we talk about passive, it really has to deal with participation levels. Whether you have 500 hours would be one way that you can get out of this 3.8% surtax if you spend 500 hours in the activity, or if you spend 100 hours in the activity and nobody else spends more. Or there's even a 5 out of 10 rule, which means if you were non-passive in 5 out of the last 10 years, this year, even if you were passive, you would not be considered passive for 1411 purposes. The third category is net gain from the disposition of property other than property held in a trade or business that is not a passive activity. So we've talked about what's subject to the tax. Now we're going to discuss what's not subject to the tax. Wages and self-employment income. As we discussed earlier, if your wages are over $250,000, if you're filing jointly, you will be subject to the additional 0.9% Medicare tax, but you will not be subject to the 3.8% surtax. Non-portfolio income from S corporations when the taxpayer materially participates. Now, what that means is the three examples I gave earlier, materially participating, if you are doing this on a daily basis, you will not be subject to the additional surtax. This is merely for passive investments, which would be under the 500 hours or not spending 100 hours. But you really need to consult with your tax professional if you have rental income or you have a business where there's a question as to whether or not you're passive or non-passive. Federally tax-exempt interest, this is because federally tax-exempt interest is not taxable. So if it's not taxable, it's not going to be subject to the surtax. Distributions from qualified retirement plans, 401ks, IRAs, those are not subject to the surtax. Same thing with Social Security income. Now, number 6, rental income of a real estate professional, if he materially participates, we've kind of touched upon. That's one that Jeff will go through in detail later, but in general, think of 500 hours, 100 hours, or 5 out of the last 10 years. The last type is gain from the sale of property held in a trade or business when the taxpayer materially participates. Just like if you're not materially participating, it is subject to the surtax. If you are, it is not. So material participation can be defined in several different ways, but generally you have to spend 750 hours or more than half of your service hours in real estate trade or business just to get into the game. There could still be a taxpayer that does have those specifications that does not qualify for the real estate exception. Now I'm going to kick it over to Jeff to go through a little bit more detail as to what this applies to.
So, to reiterate, none of the income that Bill just described in and of itself is subject to the net investment income tax. However, remember, this tax kicks in once your modified adjusted gross income exceeds $250,000 if you're married filing jointly. These categories of income do contribute to the taxpayer's modified adjusted gross income. So consider a married taxpayer who has a $240,000 capital gain and no other form of income. They are not subject to the tax because their modified adjusted gross income is below $250,000. Now, if they also took a $30,000 distribution from a retirement plan, their gross income would be $270,000. all of a sudden $20,000 of that capital gain is subject to the net investment income tax. Now, there is some good news. You can reduce the balance of your income that is subject to the tax. If, in generating the net investment income, you incurred expenses such as investment interest expense, investment advisory fees, even state taxes attributable to the income, you can claim those deductions before applying the 3.8% tax. Now, we're all aware that there are limitations associated with the deductibility of investment interest expense and advisory fees. Specifically, investment interest can only be deducted to the extent of investment income, and advisory fees can only be deducted to the extent that they exceed 2% of adjusted gross income. You do have to satisfy those same hurdles for net investment income tax purposes. Similarly, any limitations related to stock basis, at-risk basis, or passive activity losses must also be worked through. And the last thing here that we want to point out was that carryovers from prior years, such as capital loss carryovers, passive loss carryovers, may be applied against the similar categories of current year net investment income before the tax is imposed. So that is a favorable result. Now, moving on to a few issues specific to pass-through entities. Trade or business income from an S corporation is not subject to the net investment income tax, so long as the shareholder is actively involved in the business. Passive investors will be subject to the tax. Technically, the same can be said for an active participant in a partnership, including an LLC. However, one of the distinctions between an S corporation and a partnership is that trade or business income generated through a partnership is subject to the self-employment tax at the partner level. Therefore, self-employed individuals are subject to the additional 0.9% Medicare tax. There is plenty of planning that can be done around entity selection. We strongly recommend that you discuss with your tax advisor, or feel free to give us a call. Now, none of what we previously discussed relates to portfolio income. Regardless of whether you're an S corporation or a partnership, if you are generating interest, dividend, or capital gain income, it will be subject to the net investment income tax. Dividends from the earnings and profits of C corporations or former C corporations, if an S election has been made, are also subject to the tax. And then one of the items that changed from the proposed regulations dealt with the disposition of stock from a pass-through entity when you were an active participant. The proposed regulations outlined a process by which a hypothetical gain would be calculated as if a stock sale were really an asset sale. Remember, gain on the disposition of assets when you materially participate is not subject to the tax. Gain beyond the hypothetical gain would be subject to the 3.8% tax. This has changed in the final regulations, and there would be no tax levied to an active participant. There has been a lot of confusion surrounding real estate. The first thing that you have to understand is that the IRS considers real estate activities to be per se passive. As a passive activity, the income would be subject to the net investment income tax. But what about all those people that make a living in the area of property management? Does the tax apply to them? The final regulations set out a few requirements for avoiding the tax. The first is that the taxpayer must meet the definition of a real estate professional. To be a real estate professional, the taxpayer must spend more than 50% of his or her time in real property businesses with a minimum hour requirement of 750. In addition to rental and property management activities, real property businesses would include construction and real estate sales. For owners of rental properties that work in one of these fields, the real estate professional standard is relatively easy to attain. That's where the material participation requirement comes into play. In order to avoid the net investment income tax, not only must you be a real estate professional, but you must also spend 500 hours in rental real estate activities. Spending 500 hours in a year on any rental activity is a difficult proposition. There's only so many things that you can do. Therefore, the service allows you to group multiple rental activities together to meet the 500-hour limitation. As a point of caution, there may be reasons where it is not advantageous to make this grouping election. That discussion is beyond the scope of this webcast, but should be considered with a tax advisor. Another rental topic that has generated some buzz involves self-charged rent. It is very common for the owners of an operating company to keep the related real estate in a separate entity, typically an LLC, for legal reasons. The two entities, generally both owned by the same parties, enter into a rental arrangement. The proposed regulations called for the rental income generated by the LLC to be subject to the net investment income tax. Several commenters objected, and this was changed in the final regulations. This is a very confusing area, so it is definitely worth making a call to your tax advisor to make sure that everyone is on the same page. The final real estate related matter that warrants discussion is the gain on the sale of a personal residence. The Internal Revenue Code contains a very taxpayer friendly section, Section 121. Section 121 allows for the exclusion of up to $250,000 of gain on the sale of an individual's personal residence, $500,000 if married filing jointly. There are certain requirements that must be met. To the extent that Section 121 excludes a gain, Section 1411 will follow suit. Therefore, the net investment income tax will only apply to the extent a gain on a sale of residence would be subject to capital gains tax. As for planning for all of this, considering the impact that modified adjusted gross income has on the tax, it may be worthwhile to look for income sources that will not be reported on your tax return on an annual basis. Examples include municipal bonds, non-dividend paying growth stocks, tax-deferred annuities, and whole life insurance policies. Harvesting capital losses, when appropriate, is more important now than ever, and contributing appreciated property to charity rather than making a cash gift should really be considered. Having retirement assets in a Roth IRA would be preferable to a traditional IRA because there is no distribution requirement and the appreciation will never be taxed. The one downside, though, is that converting funds from a traditional IRA into a Roth is a tax event and would potentially subject income to the tax. Installment sales can be useful from the standpoint that they smooth investment income over a series of years. However, given the choice between collecting all at once today or deferring collection, it may make more sense to take the cash up front. And as it relates to passive activities, including rentals, focus on trying to hit those material participation standards that we discussed earlier. And the final planning point, just to reiterate the trust example that Bill discussed back in the beginning, consider moving the money out of the trust and into the beneficiary's hands if it makes sense and can avoid the tax. Thank you for joining us today. I hope that this session helped you understand the net investment income tax. Feeley Driscoll is a regional-based accounting firm. If we can be of any assistance, please call us at 888-875-9770 or visit us on the web at www.fdcpa.com. Thank you.